Hello and welcome to the Pro Forma Model's Parking Lot Investment Financial Model Walkthrough. The Readme tab states the model purpose, highlights common use cases, and provides an overview of functionality, formatting, and all of the unique modules within the model. This tab also provides additional documentation, contact information, and a summary of additional products and services available from Pro Forma Models to support your analysis needs. This model is highly dynamic and pre-built to accommodate institutional, private equity, and personal investment situations. Beginning on the left side of the Assumptions tab, inputs are available for general parking lot information. This is followed by Purchase Assumptions, which pulls in key metrics such as the acquisition cap rate. The following assumption section is for the investment structure and fees. This section has general investment inputs including the holding period, closing costs on acquisition and disposition, as well as investment level annual general and administrative expenses. This section also includes all of the fee calculations for acquisition fees, investment management fees, construction management fees, the target annual yield for investors, as well as the hurdles and promotes for the waterfall model calculation. Exit assumptions are also in this section, including the very important assumption for exit cap rate spread. Equity inputs are provided next, including the percentage equity contribution from general partners as well as limited partners. The debt assumptions are input next before working on the operating assumptions. The debt assumptions include the loan-to-value, interest rate, and if the loan is amortizing or interest only. The model is dynamic to accommodate an interest-only period within an amortizing mortgage, if applicable. Moving back to the top of the model, you can begin inputting operating assumptions. The operating assumptions begins with general inputs for the closing date, any vacant downtime, upfront capital expenses, as well as working capital to be funded on closing. The Parking Lot Investment Financial Model has the ability to model up to 7 revenue streams. The first revenue stream is for permit parking. Permit parking is modeled based on the number of spaces, forecasted occupancy, and monthly rate. The second revenue stream is for event parking. Event parking revenue is modeled as the product of the number of spaces available, the number of events per year, the forecasted occupancy, and the rate. The third revenue stream is for weekday hourly parking. Weekday hourly parking revenue is modeled as the product of the number of spaces available, the daily rental hours per space, and the rate. The fourth revenue stream is for weekend hourly parking. Weekend hourly parking revenue is modeled as the product of the number of spaces available, the daily rental hours per space, and the rate. The fifth revenue stream is for valet parking. Valet parking revenue is modeled as the product of the number of annual customers and the rate. The sixth revenue stream is for vehicle detailing. Vehicle detailing revenue is modeled as the product of the number of annual customers and the rate. The seventh and final revenue stream is for other income modeled as a direct annual input. Operating expense assumptions are input next. Assumption inputs are available for insurance, property tax, staffing, contracts, repairs and maintenance. Utilities, valet expenses, detailing expenses, general and administrative expenses, advertising expenses, as well as property management fees. The final assumption input is for annual capital expenses. Please note that you can zero out and skip any assumptions that are not applicable for your use case. The Pro Forma tab contains all key calculations for the model. The Pro Forma tab starts by reconciling the annual number of days in a year broken down into weekdays, weekends, and event days. The next section calculates the annual revenue for each of the 7 revenue streams based on the user input assumptions. If a revenue stream is not applicable to your use case, the zeros you enter in the Assumption tab will result in zero revenue to exclude the revenue stream from the model. The next section of the Pro Forma is the income statement. The income statement consolidates all of the revenue streams and pulls in the user input operating assumptions to develop a pro forma net operating income. The capital expenses and investment general and administrative costs are deducted from the net operating income to develop the income before debt service. Debt service is deducted next to develop the net income after debt service. The next section calculates the annual fee basis for investment management fees. Please note the model is pre-built to calculate investment management fees on an equity, cost, and value basis. The following section tracks capital balances, including the general partner and limited partner equity as well as debt, on an annual basis. A summary pro forma investment cash flow is then presented, beginning with net operating income. Interest expense and fee expenses are deducted from net operating income to generate the funds from operations. Annual capital expenditures are then deducted to develop the adjusted funds from operations. The principal payments and vacant downtime are finally deducted to calculate the free cash flow to equity. The target yield is calculated based on the investment yield assumption entered. The yield is utilized to calculate the annual cash surplus or deficit. This section also includes key payout ratios. The sources and uses table is presented next. The uses section shows how capital is distributed on closing, while the sources section shows where the capital is coming from. The model then begins to present returns. The returns section begins by showcasing the gross unlevered internal rate of return, yield, and multiple of capital. The gross levered internal rate of return, yield, and multiple of capital are presented next. The general partner and limited partner deal level internal rate of return, yield, and multiple of capital are presented next. Please note the general partner and limited partner cash flow includes the pro rata performance fee calculated from the Waterfall model, which we will walk through next. The pre-built Waterfall model begins with the gross levered cash flow and subtracts fees gained by the general partner to get a starting distributable cash flow. The Waterfall model begins by providing a return of capital to limited partners. This means that cash flows are distributed to limited partners to deliver a 0% internal rate of return. The waterfall then delivers a preferred return to limited partners. The case study example utilizes an 8% preferred return rate. The waterfall is pre-built to handle a two-tier promote structure. The preloaded case study example utilizes a first tier of 15% over 8% but less than 10% and a second tier of 25% of returns over 10%. All waterfall inputs, including the preferred return, hurdles, and promotes, are fully customizable to your specific use case. The Debt Schedule tab is completely dynamic and starts with a summary of the mortgage assumptions in the loan details section. The debt schedule is organized to break out each component, such as principal, interest, and prepayments, so a user can see all components of their total payment. The model has the ability to reflect an interest-only period within an amortizing loan and also has the ability to utilize floating rate debt. The loan summary section highlights the impact of prepayments. The Data Validation tab contains all controlled lists within the model and can be customized to your specific use. The Output tab contains the high-level decision-making reporting from the Pro Forma Model analysis. The top of the output report begins with the consolidated sources and uses table showing the allocation of funds on closing and where capital will come from. For those that prefer to visually analyze data, the uses are presented as a distribution chart showing how each incremental cost contributed to the total cost. The sources are also presented as a bar chart showing the pro rata share of general partner and limited partner equity as well as debt. Returns are presented next, including the internal rate of return, yield, and multiple of capital on a gross unlevered, gross levered, general partner levered, and limited partner levered basis. To assist with analysis, the returns are presented in a data table and visualized as bar charts. The next section of the report highlights the annual capital balances for the general partner equity, limited partner equity, and debt. Data is presented as a data table as well as a line chart for those that prefer to analyze data visually. A summary cash flow is presented next, showing key financial line items, including net operating income, funds from operations, adjusted funds from operations, and free cash flow to equity. This section also includes key payout ratios. The report ends with highlighting key operating figures. An operating schedule is provided showing the annual total days in a year, number of weekdays, weekend days, as well as event days. This data is very useful to see the breakdown of operating days per year for the investment horizon. The last section of the output report details a clean breakdown of the revenue attribution in data table and pie chart form for those who prefer the visualization. The revenue attribution is a useful tool because the parking lot investment could have up to 7 revenue streams. In the model walkthrough case study example, this investment predominantly derives revenue from weekday hourly parking, event parking, and weekend hourly parking. From a quick review, it looks like there may be opportunity to improve revenues by focusing on increasing permit parking to drive stable recurring revenue as well as to market ancillary services to grow the valet and detailing service business. Thank you for tuning in. We hope you enjoyed this Pro Forma Models walkthrough and encourage you to visit our website to try the model for yourself.